Welcome to today's explainer. All right, let's just jump right into it. Right now, we're looking at US markets that are, well, just stubbornly grinding higher. But if you look underneath the surface, there is a highly active, totally wild rotation happening. We're seeing incredibly narrow leadership out there, which basically means you've got to be hyper-strategic to actually find success. So today, we're going to cut through all that noise. We're breaking down two entirely distinct playbooks that we are tracking this week: the value pullbacks in quality blue chips and the high-flying momentum leaders. Let's visualize exactly where these opportunities live. So what does this split tape market actually look like? Well, imagine two completely opposing forces pulling at the market. On one side, we have our oversold value bucket. These are massive, fundamentally sound quality stocks that have just been completely punished by recent sector rotations, and a lot of them are sitting right near 52-week lows. And then, completely opposing them, is our momentum bucket. These are your trend followers, especially in energy, consumer travel, and some select tech names that are basically defying gravity right now. This sharp divide, that is your exact blueprint for navigating the rotation this week. Okay, here is our game plan. We're going to start with the August split market tape, move right into Playbook 1 on value pullbacks, hit Playbook 2 for momentum leaders, look at some short-term tactical speed trades, and then, finally, execution framework and risks. Section 1. The August split market tape. Let's diagnose exactly what is driving this bizarre dynamic where indexes hit records while leadership flips daily. Look, the broader averages might be grinding higher, but they are doing it against some seriously stiff macro headwinds. I mean, Brent crude oil is creeping right up to that $90 to $100 mark. Actually, scratch that. It's not just creeping, it's surging. And that is a massive threat for inflation reacceleration. You add in a ton of rate path uncertainty under the Fed, and worsen, looming 10 to 12.5% tariffs on the EU and China, and early signs of exhaustion in megacap tech. Yeah, you've got a perfect recipe for sudden volatility. We absolutely have to use a split tape approach to survive this. Which brings us perfectly to Section 2, Playbook 1 on value pullbacks. This is where we go hunting for mean reversion setups. We are currently living through what Wall Street is quite dramatically calling the SaaS Apocalypse. It sounds like a bad sci-fi movie, right? The market is just terrified that new AI coding agents are going to completely destroy traditional software and consulting models overnight. But here's the thing. For the core businesses of these giants, that disruption hasn't actually shown up in the fundamental data yet. It's a total overreaction. And that fear is creating some historically cheap valuations for incredibly high-quality companies. Take Lowe's, for example. This is a really fascinating defensive consumer home improvement play that's actively attempting to build a base. Yes, the price is sitting below both the 200 and 50-day moving averages, but the momentum, that's the real story. The RSI is sitting deep in the oversold zone around 32, and the MACD trend indicator is finally starting to flatten out. What I absolutely love about this setup is how clearly defined the risk is. If we get a daily close below that key support zone on heavy volume, like 1.5 times the 20-day average, the thesis is broken, and we just step aside. Simple as that. Now, let's put two prime victims of this AI panic side by side. First up, Accenture. We are talking deep value here, trading roughly 66% below its historical fair value metrics, and it's starting to flash a bullish divergence as its MACD crosses upward. Then you have Salesforce. It's currently sitting at a ridiculously low 10.6 price-to-earnings multiple. Plus, they have this massive $37 billion buyback floor acting as a giant safety net underneath the stock while the RSI improves. Continuing with the value bucket, Intuit is a super rare find right now. It's offering a historically high dividend yield of over 1.8% at a really steep discount. It is deeply oversold. Honestly, we're just waiting for a high-volume bullish reversal candle to trigger the entry. But Adobe is the real jaw-dropper. It's trading at a massive 74% discount to its historical free cash flow multiple just because of AI fears. Unbelievable. Just remember, for Adobe to confirm a true bottom, we need to see it break and actually hold above that 21-day EMA. All right, shifting gears entirely. Section 3, Playbook 2 on momentum leaders. We're moving from the bargain bin straight into the high flyers. So if our value plays are scraping the bottom, Palantir is basically in orbit. It is an absolute beast right now. It's the top S&P 500 momentum leader, totally driven by enterprise AI deployment. You can see the price is significantly above the moving averages, and those EMAs are fanning upward perfectly. But listen, because sentiment is incredibly crowded and the RSI is extremely extended, discipline is absolutely crucial here. Do not chase this at the top. The playbook strictly says to wait patiently for a pullback into that 21 or 50 EMA zone. As long as it holds the 50-day EMA, the big trend is completely intact.
In a very similar vein, we have GE Vernova. This company is capitalizing in a massive way on structural power grid and clean electrification spending. What stands out here is just how highly orderly the price structure is. It's staying well above those long-term moving averages, and the momentum is just humming along securely in that bullish 50 to 70 RSI zone. For a trend this clean, a daily close below the 50-day simple moving average is your strict line in the sand. If that breaks on volume, the momentum is dead. And momentum is definitely broadening out well beyond just the tech sector. Take a look at Tapestry. It's breaking out of a secondary consolidation in consumer discretionary. Then you have Royal Caribbean, which continues to completely defy all macro headwinds, riding a highly predictable ascending channel. But I want you to pay very close attention to Vistra. It's been this parabolic utility leader tied to data center power demands, but with its RSI above 70 and flashing early signs of exhaustion divergence, you really need to be careful of a bull trap there. Tighten up those trailing stops if you're in it. Okay, for those of you who like a little more velocity in your setups, let's jump to Section 4, short-term tactical speed trades. Now, Delec US, PBF Energy, and American Airlines, these are entirely different animals. This is our high-beta tactical universe. They are hypersensitive to immediate intraday macro headlines, especially that $90 Brent crude threat we talked about earlier. Trading refining margins or airlines while oil is surging is incredibly volatile. That is exactly why these are strict 2 to 5 day holdings. You do not marry these stocks, you catch the momentum surge, and you get out. Which brings us to the most important part of the day, Section 5, Execution Framework and Risks. Let's be honest, having a watch list of great charts is completely useless without a bulletproof plan to actually trade them. Before you execute a single one of the setups we've discussed, I want you to run it through this 4-part confluence checklist. Don't just buy something because it sounded good on an explainer. You need to stack the odds. Filter the trend using your major moving averages. Confirm momentum alignment with the RSI and MACD. Verify the price structure to ensure you're entering in a defined pullback zone. And finally, wait for that trigger, a clear reversal candle backed by at least 1.5 times average volume. This checklist keeps you disciplined when the market gets chaotic. And please, if you only take away one single thing from this entire explainer, let it be these strict risk management mandates. This is how you survive and thrive in a split tape. First, demand a minimum 1 to 2 risk-to-reward ratio before you even think about an entry. If it's not there, skip it. Second, when we have major Tier 1 macro data dropping or an earnings call, scale down your position sizing. Protect your capital from those nasty overnight gaps. And lastly, ruthlessly honor your daily close and validation levels. Hope is not and never will be a valid trading strategy. So I'm going to leave you with this Sichuan for the week. In a market that is just grinding higher on such incredibly narrow leadership, how are you positioned right now? Are you hunting for value and trying to catch the mean reversion of this whole SaaS apocalypse? Or are you just going to ride the prevailing trend with the momentum leaders? Let me know which playbook fits your style in the comments. Thanks so much for joining me today, and I'll catch you in the next explainer.